All right, good afternoon, ladies and gentlemen. I hope you're doing well. So, we're going to go through some selected multiple choice questions, and these questions could be some of them, it's because of their importance, the others would be because you have in the survey informed me that these are the most difficult ones. So, let's start with this first question, which is which one of these is an intangible assets. So remember what we mean by tangible. Tangible is something that is being, like touch or you could observe, you could see it. So when we have intangible assets, these are assets that you cannot really see or you touch it or it doesn't really you cannot really hold it, but it has some significance in it. For example, a building is something that you can see, so it's not that. Machinery is something that you can see, like a printer or anything like that, so you can see that. Vehicle as well. However, when it comes to loan, although you cannot see it, but it is available, it is something that it's tangible, right? But when it comes to trademark would be the answer, because a trademark is just a symbol which doesn't really can be touched, but it only like represent a certain brand or a company. Alright, so the other question that we're gonna be solving right now is the second one, which is this one. The process of planning and managing a firm's long-term investment is referred to as capital budgeting. Just let's remind us ourselves what we mean by capital budgeting. It is a term that we use to describe the process of making and managing expenditures on long-lived assets. And this is basically what is meant by here. It is a process of planning and managing a firm's long-term investment. So this might be definitely the possibility. All right. So since I know that this is the answer, I can stop here and just answer, right, circle A. However, I'm gonna go through these definitions as well. So let's talk a little bit about agency cost. Now remember, this agency cost, it's a term that usually refers to the conflict of interest between stockholders and management, right? So when there's a problem between both, the management team and the stockholder, for example, the stockholders could benefit the management, but it's gonna cost them, so we are not really certain about that there is a good relation. So what they do is they try to contact another agency that allows them to do the study, an independent study, to test if there is any like conflict of interest. And this is basically the agency cost analysis, which things that need to be underpinned. But this has nothing to do with managing firms' long-term investments, and that's not the solution for this problem, obviously. Financial depreciation is something that is non-cash item that is usually considered among things that are expenses against revenue. So you know that if you buy a certain machine, in 2 years time it's gonna be depreciating in its value. So you have to account this in the balance sheet, and therefore this is never related to the managing of firms' long-term investment. All right. Working capital, on the other hand, refers to the differences between current assets and current liabilities, like accounts payables. But basically, it's never related to what we mean by long-term investment, and because it's current, so there's nothing to do with the management of working capital. The question here says capital structure refers to the. So remember, we already have spoken about what we mean by capital structure, right? Or capital in a way or another, we spoke about capital budget. So capital structure refers to the method by which as fixed assets are used to produce a tangible product. Well, this answer is not actually right, because it doesn't refer to that, because like fixed assets are used to produce a tangible product is not in this direction, because it doesn't has to do any relation with capital structure. Just remember, when we talk about capital structure, it's basically the idea that how firms finance its overall operations. All right. And that the sources, we're looking here at different sources of funding the operation that they need to deliver. So a mix of current assets and current liabilities, that's nothing to do with capital structure. Acquisition or this position of building or other long-term assets that, like this, nothing has to do with this. Decision related to long-term debt and equity financing, which is basically the answer to our problem. So this is gonna be our answer. It's D. Okay. So the other question that we're gonna be solving is question number 8. Which forms of business is treated as a distinct legal entity separated from its owners? So this is trying to asking you which business association is considered to be, to be treated as separate from its legal entity, from its owners. So remember what we mean by limited partnership. A limited partnership usually refers to, a form of a certain partnership. So like two or more people have joined together to open a certain business. However, in this case, we have at least one of the partnerships should be a general partner, while the other could be a limited partner. When we see a limited partner, this means that they have limited liabilities. And a limited partner has no management authority, and they are not liable for debt of the partnership. So, they don't really have a lot of risk associated with that. So that's why we say they are limited partner. But are they treated separate? Now, obviously not, because this kind of a business association is linked to one of their general partnership who is somehow has the full responsibility and he is liable for his actions. When we talk about sole proprietorship, when we talk about that means that he's a single man who is opening his own business, or a single woman who is opening her own business, and therefore she is liable for her actions. So that's not the answer to our question. The general partnership, I just explained to it what it means. This partner or this person is liable for his acts, so it doesn't. He's not being treated as a different. His corporation or his business isn't being treated differently from him in a liable manner. While corporation is the right answer for our question, because a corporation is, regardless of who's managing it or who's running it, is being treated differently if the corporation fails. And this happens so many times, and this is one of the ideas of capitalism brought to our world, which is we are treating business as a separate entity from the owners. So if the business failed, something happened, something bad happened, you cannot go and tell the person who was in charge of the business, hey, you need to pay me back the money, or you've just gone. And it is a bit risky, but it is less risky because it's a big corporation. So the third question, which is both limited partnership and corporation, no, that's not true, because a limited partnership is also considered to be one of the members who is trying to do decisions, but his partner is considered to be the liable person. In this question, we're going to go to question 12 now. Art purchased 2,500 shares of Delta stock. His purchase represents 10% ownership of the firm. So he owns 10% of the firm. His shares have increased in value from $12 a share he originally paid to today's market value, which is $13 a share. Assume Delta goes bankrupt. So this is a corporation that goes bankrupt and owes $450,000 more in debt than the firms can pay after liquidating all of its assets. So basically they are in debt with $450,000. What is the maximum loss per share Art will incur on his investment? So basically he will actually only lose his initial amount, which he initially put, right? So which is $12 a share. He wouldn't lose more than that. Okay, so it's only the first money he put in, and therefore the answer is gonna be B. Now the other question that we're gonna be solving is question number 17. Which type of business organization has all the respective rights and privileges of a legal person, So this question we have already answered it previously. So we spoke about sole proprietorship, and we spoke about the corporation, general partnership, limited partnership, and limited liability company. So we said that the only thing that actually works as a separate entity is a corporation. Okay, now the other question that we're gonna solve is question number 24 over here. And basically, which form of business structure faces the greatest agency problems? Now remember, when we talk about agency, is that we are recruiting a certain person or a separate entity who is trying to resolve a certain problem, right? Now obviously, as a person, one person who is owning his business, it is less likely that he's gonna be recruiting an agency to let him to solve his problem between him and himself, right? So, for example, we cannot say that a sole proprietorship will more likely be a person who is going to be ordering this agency to solve his problem. So when there is a problem, basically there is a certain people who are running the company, which is a management team, while the other person who owns the company, which is shareholders, when things get a problem between these two entities, separate entities, then we really need an agency, and we need to solve this problem between conflict of interest. And therefore, which form of business structure faces the greatest agency problem is definitely going to be corporation, because the management team are separate from the shareholders. They are not the same person, and therefore it is more likely that we're going to be needing an agency problem in case of any problems in the future or at the current time.